Welcome, everyone. Once again, I'm Raj Malhotra, Senior Trading Mentor. So today I want to talk about what's been going on in the market and something that's caught my eye. Now, there's been a lot going on this week between economic data and earnings. And as I filmed this, yesterday the FOMC had met, and they announced a likely shift in the policy going forward to signal likely future rate cuts. But apparently that wasn't fast enough for the market that was hoping for them starting in March. Now, I think it's a mistake to wait, but maybe the Fed wants more evidence of low inflation. Maybe they've got political calculations because it's an election year. But at the end of the day, who really cares and who really knows? But one thing I do know and I do care about are that there are a lot of frustrated bears out there, and I can confirm that by the hate mail that I've been consistently receiving from the doom and gloom crowd. But one thing I can say again is I just don't see the strong bear case, which is likely to pop up again after yesterday's numbers. Now, looking backwards and non-emotionally is what you should do as traders. If you look at that, what's actually happened and taken place over the last 2 years is a very normal and a very subdued correction, as you can see from this chart right here. If you look at this, after its January 2022 high, the market had a 9-month correction of 27.5%. And it took a total of 24 months for the S&P to rally back, up 38% from its low. It has to go up more than when it goes down. That's just math. And when it had that 38% rally from its low, it took out its January 2022 high and reached a new all-time high. And as you can see here, the median number of months for a 20+% correction to rally back from its all-time high is 25 months. So pretty much exactly the same time. So this isn't unprecedented by any means. And in fact, it's completely predictable. The 38% rally from the 2022 October low, that's also consistent with the median average rally of 40.5%, 40.5%. So again, exactly what it was supposed to do. And you can also see that this correction wasn't nearly as bad as some of the past corrections, which averaged a 36% sell-off, and with it being as bad as an 86% sell-off. Now, maybe that's why bears are frustrated, because they expected a bigger sell-off. But the thing is, and the difference between this correction versus those other ones, we never actually had a recession. And in that sell-off, and in fact, it wasn't even close. What I really think happened was the initial rally from COVID was just a pull forward that was unprecedented, and maybe that's what confused a lot of the market. If you look further at the next table, past data shows there is a potential for a much higher S&P 500 if you look at historical rallies. This data right here is fascinating. The median rally after big correction is 106% after 49 months, just over 4 years. So if the market follows this pattern, that suggests the S&P should rally above 7,000 by the end of 2026. Now, if you look at the average rally rather than the median rally, history suggests that we should be above 8,000 by the end of 2026. Now, I know that's a lot for you to take in, and some of you are still non-believers and think that those numbers are crazy, but that's just what history has told us. Again, there's no guarantee that history will repeat itself, but it's certainly possible. And, I know even though I know some of you still don't believe that can happen, even though I've been consistently one of the only people since all of 23 calling for a big rally, and particularly a big rally in Q4 and a follow through into the beginning of 2024. I just continue to think that there is the potential for another near-term rip and kill some more of the angry bears out there. The ones, especially ones just keep parroting the same talking points they've been growling for all of 2023. I think if we get this rip your face off rally, it likely continues towards the end of Q1, and then maybe FOMO finally sets in. When those guys finally throw in the towel, maybe that's the end of it. Maybe not. TBD on that. But the point is, we could easily see another rip your face off rally, and FOMO will finally set in, and that's probably that's when sentiment changes, and maybe that's the end of everything. But one thing I like to say is, and I said it on my last flash in November, I just don't think the leadership will be the same leadership as in 2023. You're starting to see that already in earnings season. As I film this, Microsoft, Google, and AMD all reported outstanding numbers this week, but were flat to down post-earnings. To me, these big tech names and others like it probably just have limited upside from here. I'm certainly not saying that they're going lower, and they certainly could go higher. I'm just saying that they're not going to be the leadership and probably not outperform the rest of the S&P like they did in 2023. I think the rally is much more likely in small to mid cap names, which have been underloved and underowned, and as you can see, they've lagged big time here. So I'm focused on these sectors that have been underloved, like financials, utilities, consumer discretionaries, industrials, maybe, just to name a few. I'm also looking at, like if you look at this week, for example, just a data point, look at an underloved industrial/consumer company like General Motors. The stock is up over 10% since earnings, despite inline numbers, plus uncertainty around future EV sales and higher labor costs. Their narrative was just so negative and so bleak, it was easy to beat. CLF, Cleveland-Cliffs, is a big steel producer, same thing, up double digits on marginal earnings. Again, expectations were so negative, it's easy to beat lower expectations. I think, a lot of these names, there's potential for 30, 40, 50+% rallies if you look in the right place. And I really do believe there's a broadening out of the market will happen, and that's where to look for these bargains. The other good news for you guys is the VIX is trading around 13, so you can set up great risk-reward trades into earnings and beyond. And if you're wrong, and if I'm wrong about this, then you have a limited downside, but pretty big upside, and really good risk rewards. Let me give you an example of a name that I've been looking at, the small cap that's underloved in a hated sector, which is consumer discretionary. It's had a big sell-off and has been misunderstood. Groupon, GRPN, it's an e-commerce company offering discounts on certain services to customers. It's got brand names like Groupon, Living Social, a couple other ones outside the country. Now the company is pretty recession-proof. People are always looking for deals because people are cheap. It's also trading at a sub $500 million market cap, so you could easily get back to $1 billion without much of a problem. Stock's up about 56% in the last year, but still down a massive 82% in the last 5 years. So if you look back to last earnings quarter, the stock got killed because the market completely misunderstood a fully backstopped rights offering. The stock has pretty much gained all that back as the markets learn more about that rights offering, and that rights offering is actually being completed already. And the stock is now poised to go much higher with any bit of decent news. To me, the stock could easily get to 21, 50% higher on just okay earnings, given all the pessimism and short interest. You could pay $1.50, you could see here, for the 14.21 call spread. If you are right on that, it gives you almost a 4-to-1 payoff. I also may be completely conservative on that $21 price target. If the shorts really get squeezed, that's the case, maybe just buy them out, buy the at the monies outright, or buy some upside calls outright, and then you could really get a sick risk reward. And if that happens, the good news is you won't need to shop on Groupon anymore, and you can start affording to pay full price. For that, guys, thank you very much. I'm Raj Malhotra. I'll see you guys on the other side. Happy trading.